VKTX published good results for its pill. Yeah, I don't follow a lot of the pharmaceutical stuff just because of the volatility of them. VKTX, Viking Therapeutics. Yeah, up $4 today. Don't know anything about this company. Market cap $8 billion. Liquidity, let's check it out. Yeah, this is not really tradable as far as options. The liquidity is pretty bad. You got a $2 wide bid-ask spread, so can't really do anything with it. Also, with pharmaceutical, any kind of pharmaceutical companies, biotech companies, you got to be careful with these things because they do have a tendency to make gigantic moves, especially when it comes to drug trials. You know, they could explode upwards in price or drop 50% in price. You know, they can make some crazy moves. Selling naked options is very risky in these kinds of things. So I know it seems exciting, you know, stocks that make gigantic moves, but you know, there's just safer ways to make money than playing these things. But the real problem with this company is just, you know, the options just bad. Even the front month, 11 days to go. You think, you know, open interest is not very high in this, except for the every $5 wide strike has pretty good open interest, but the other ones, I mean, dollar wide, this one here is a $2.60 bid-ask spread. Yeah, can't really trade that. You're just you're giving up too much money on those wide bid-ask spreads because it's going to be horrible feels. Reddit, yeah. Haven't looked at Reddit in the last few days. I think I did play the earnings. I made a little money on the earnings. But yeah, Reddit had the big up move, and you know, it's coming back down, kind of as expected. When something makes a gigantic move like that, typically it's, you know, people are going to take profits a little bit. Plus, the market's been weak, so coming back down to earth a little bit. Let's see what the bid-ask spreads in this. These are not great bid-ask spreads either. Not as bad as the last stock we looked at, but you know, 35-cent bid-ask spread, 40-cent bid-ask spread. Pretty wide. So not, I wouldn't say it's untradeable. Well, some strikes are untradeable. Like this is a dollar wide bid-ask spread. That's I would be careful trading this. Again, because there's so many, you know, you got thousands of publicly traded companies out there. Avoid the stuff that, you know, isn't terribly liquid. And the reason is you're getting bad prices on this, like this bid-ask spread, this dollar wide bid-ask spread, 105, 191. Well, what's a fair price for this option? I don't know. It's such a wide bid-ask spread. If I, you know, selling this, I get a feel at 148. Is 148 a fair price for that? I'm not really sure. Only 15 people are trading this contract, you know. And then when I go to buy it back, what am I going to have to buy it back at? $2? I mean, it could be something crazy. You could be in a situation sometimes with these low liquidity stocks where, you know, I've had this happen to me where I sell an option for, you know, $1 credit. And then I realize, you know what? I don't want to play this. Let me just turn around and get back out of it. And I got to buy it back at $2. Like I lose $100 just on a quick 5-minute turnaround just because of that huge bid-ask spread. So be careful of these really wide bid-ask spreads on these stocks. I got a question here. Yeah, you new to the channel, reading the book. If my account size is 700,000, I find it strange to sell a put for a few $100s, taking a big risk if something like SMCI happens, or even McDonald's a few weeks ago. When I do a spread and I know my risk, I find it easier to take bigger trades. Yeah, I mean, you have to understand too, the more you trade, like SMCI, I don't trade that. I've never traded that. That's not a stock I would have been in anyway, right? You don't necessarily have to take that kind of risk on these things that move around, like the Viking thing, you know, biotech stocks, pharmaceuticals, any kind of meme stock. Reddit's kind of memey, right? There's nothing wrong with trading Apple, Microsoft, Nvidia, Meta, Amazon, Google, you know, real companies that, you know, they might occasionally make big moves on earnings, but they're real companies. Like if Google collapsed, I don't know, 20% on earnings, Google just tanked on earnings, well, that's fine. it's still Google. It's going to go back up, right? Where a stock like SMCI is more likely to go to zero than actually recover its share price. So yeah, just trade the real companies. You'll this is one of the things, especially when I started trading, not just options, but stocks too. When I started trading stocks, I'd trade some of these garbage companies, these penny stock, low float companies, because, people on the internet told me that I'm going to make $1 bajillion trading these companies nobody's ever heard of. And, most of them I either lost money in. A few of them, I had at least 2 of them that actually went bankrupt while I held shares of their company. And of course, I lost everything, right, that I had invested in those companies. So yeah, the more experience you get, you're going to gravitate to more of the big name companies, and a lot of people try to go find that weird stock nobody's ever heard of, because that's the one that's going to make me money, because people think that everybody else is trading Google, everybody else is trading Apple and Amazon. I'm going to go find this weird stock nobody's ever heard of. And that way, when I make money, I can tell people about it. And, people will think I'm a great trader because I did something special. Well, there's a reason everybody's trading Apple and Amazon and Google. It's because that's where all the action's at. That's where all the liquidity's at. That's actually where you're much more likely to consistently make money. That's why everybody's there. And of course, you don't even need to necessarily do single stocks. There's a lot of traders that all they trade are either the index ETFs or the index futures. So like with the S&P products, there's a lot of people that only trade SPY or SPX or the ES futures. There's plenty of traders out there that they're a single product trader, and that's all they trade. All they trade is the S&P 500. And that solves the problem of you don't have to worry about earnings events and weird single stock risk of, the CEO of the company jumped out of a high-rise building and killed himself, and then the stock crashes 30%. Like, you don't have to worry about that when you trade indexes. Sometimes it's okay just to take a loss. Most of the time on my short puts, or short calls for that matter, my short options, most of the time I just close them for a cash loss. I'm not trying to take assignment on most things. Also, you have to take in the time factor. Like if something went against me really quick, and I'm thinking, well, I could just take the loss now, or I could sit on this trade for the next month, the next 2 months, and see if it comes back to me. Well, I also have to think, well, what could I do with this buying power that I've got tied up into this position over the next month or the next 2 months, whatever time frame it happens to be? Could I actually put that money to use somewhere else and actually more than make up for this loss I'm about to take on this position right now? So you do have to take into to factor the time cost, the opportunity cost. You don't want to be stuck in a trade forever. Even if you eventually it works out and you win a little money, if you're in a trade for 3-4 months, fighting it just to break even, where, in the first week or two, you could have taken a small loss. It was probably better to take that small loss early on and just move on. Because then, you could have put that capital to work somewhere else and more than made up for whatever it is you eked out on a small win. Yeah, would you close all your positions at the end of the year? No, I don't do that. I'm not, like the big hedge firms, mutual funds, things like that. They might do that just for accounting purposes, where they clear all their books at the end of the year, just so they have, 2024, hey, that's a wrap for this year. We'll start putting on trades for 2025 the next year. Even if they just close trades and put on the same trades the next day, I don't need to do that. I'm not trying to do all that. It's just me trading for myself. I'm not an accountant. I'm not sitting here worried about keeping books on anything. Some people close positions for tax purposes, if you need to do that. A lot of that will be like long stock positions, passive investing positions. Yeah, I just prefer a trade to be around 3K. With negative puts, I fear the risk is huge. Well, if you want to trade something around 3K, as far as you want to risk about 3K, the way I look at it is, what is the buying power reduction? So let's go to that 46-day Google put. 168 credit, buying power reduction of $2,000. I would consider that my realistic max loss, a $2,000 loss, because that's what the broker, the way the broker figures out your buying power reduction on naked options is they take a 2 standard deviation move against you, so the stock falls 2 standard deviations against you. What should you have in your account to cover that loss? Well, they calculate that to be about $2,000 in this case. That should cover your losses at least 95% of the time. So if you don't want to risk more than $3K on a trade, selling a naked put, for example, here in Google, perfectly okay. Keeps you under that number. We go to a higher price stock, Microsoft, and we sell a similar kind of put. Go to the 20 delta. See 425 on a buying power reduction of 5,200. Obviously, that's a little higher than what you wanted because the stock is a higher price stock. Volatility also will play a factor in that buying power as well. So this one you might, instead of doing a naked option, this might be one that you do a spread on, like a put credit spread instead of just a short put. So that's the way to think of it. Most things, IWM, for example, $220 stock. You could probably sell a put in this. Being an index product, I doubt it has a terribly high buying power requirement. 20 delta put here. Buying power, $2,600. So that's the way I think about it on naked options, is a realistic kind of max loss that you need to be prepared to take is the buying power reduction on a naked put, naked call, naked strangle. Yeah, so you would have to double however many contracts you want to do with the spreads, you can just, yeah. You don't necessarily have to buy that many spreads though. What you could do, let me go back to the Microsoft example. This would be a great example. So the 20 delta put, you only want to take $3,000 worth of risk, but this naked put, you're taking $5,300 worth of risk. Well, if you do a spread, I mean, you could do this really trashy credit spread, put credit spread, 75-cent credit on a buying power reduction of 425. That's way too tiny of a trade. You were wanting to risk $3,000. Well, take that long put and just put it way the hell out here somewhere. There you go. You're buying the 6 delta put. Now you're receiving a credit of $300 on a buying power reduction of $2,700 for one spread. You didn't have to, if you do the tiny spreads, then you got to bump it up and do a bunch of contracts. You're paying a lot of commissions to get, like this one here, I'd have to do at least 7 contracts, risking $3,000, max profit of $525, where if I just do one contract of this, I'm getting $300